Hello and welcome to What the Finance is to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Matthew Piepenburg, who's a principal from Matterhorn Asset Management. Matthew, thanks for joining the podcast today.
It's a pleasure to be here. I'm looking forward to the conversation.
Yeah, I'm looking forward to it as well. And you've talked a lot about, I guess, our current system and concerns you have with it. But then, from my perspective, I guess it's been quite resilient. And despite many people saying otherwise, it's sort of survived these economic collapses, COVID, money printing of the last decade. So I guess, why won't it just continue to muddle along? Why do you think there could be a collapse potentially?
Yeah, I mean, it is impressive. I mean, how much a money printer in Brussels or Washington or Tokyo can do for an economy, for a market. Those are often two different, very, very different things, often confused as the same thing. No one can define the expiration date of this bacchanalia, this what I consider a completely artificial economy and an artificial market. The idea that it was a fringe theory years ago, modern monetary theory, that you could monetize your own debt and then and call that a solution. I mean, if you told a 10-year-old, look, if we just print money, and then if we need more money, we'll keep printing more money. I mean, it sounds so simplistic, but it's so ridiculous. And yet when the markets are ripping and times are good, the idea of solving a debt crisis with more debt and then paying for that debt with money that's literally mouse clicked, no one wants to think of how absurd that is when it's so patently absurd from the very beginning. It was meant to be an emergency measure in 2008, 2009. Bernanke at the time said just a year, no more. And then QE1 became QE2, QE3, QE4, Operation Twist, unlimited QE. It went on for well over a decade now. And then, of course, in March of 2020, we went from a $3.5 trillion balance sheet to a $9 trillion balance sheet in a matter of 1.5 years. We printed more money in 1 year than in the 2008 to 2014 and onwards. So it seemed like the perfect solution. Again, if we had money printers in our basement, we'd all look very successful. Our tuition, our car payments, our mortgages, our social life, our vacation lives, all would look good because we could just, and who wouldn't get addicted to that? This idea, though, that, we have over 380 trillion in global debt and GDP at 1/3 of that. In the US, we have over 90 trillion in combined household and corporate and public debt. It's an unfathomable number. It's frankly abstract now, kind of like a war crime. When there's so many deaths, it's hard to even fathom it. Once it gets but a certain number, it's the same thing. It's a financial crime, and it's hard. Again, this isn't even gloom and doom. This is just common sense. But common sense goes out the window when markets are ripping. I mean, I saw that myself in the NASDAQ bubble, in the dot-com bubble. I knew it was absurd, but we were all making money. And then the same thing lead up to 2008. We knew it was absurd, but when the markets were up, it's out of sight, out of mind. So your question, getting back to your question, this idea that it's just muddying along, well, it's really not muddying along. We've got the greatest wealth transfer in history in Western economies, certainly in the United States. This asset bubble that we've manufactured, engineered, the trillions of printed dollars, most of that went straight into the bond and market, which indirectly went into the U.S. equities market. So we had the biggest stock and bond bubble I've ever seen, and I've seen a few. I've studied a couple more. It's the largest wealth transfer in our history, and 90% of stock market wealth in the U.S. and the S&P, the Dow, or the Nasdaq is held by only the top 10% of the population. So it's really a wealth transfer, and it's really an engineered. I think it's an engineered fraud in a sense, because it's when you print money that's not linked to an actual good or service or a real asset. It's inherently inflationary. So no, I don't think it's sustainable. I don't think modern monetary theory or modern monetary policy is sustainable. It is a keg party par excellence, and it can last. I joke kind of cryptically that it's like martinis, or it's like a keg party. It's because it is an addiction. Metaphorically, it is an addiction. It feels great when you're buzzed and when you're riding it, and everything looks beautiful and everyone looks smart and every decision seems brilliant until the hangover comes and everything looks ugly, every decision looks stupid, and you look back and say, how could I have drank that much that weekend? But this keg party's gone on for years instead of months, and no one, including myself, can predict the expiration date. And an even more dark analogy, it's kind of like leukemia. My father had cancer, and thank God he made it through. But he was, some people, I've known people who've survived and some who haven't. But when you have a cancer in the system, Some people can last for 15 years. Some people don't make it through the summer. And so, in a sense, we have a cancer in the system. We have an artificial system. We have a monetized debt system. We have record levels of debt. We have massive counterparty risk and broken exchanges. And so, again, this is, and we can go into specifics on this. It's not an exaggeration. The debt scenario today is unacceptable. It's unpayable. It's unsustainable. And it's just a question of when the music stops. There's only a few chairs. There's a lot of people looking for those chairs. There's not a lot of liquidity. So no, it's not gloom and doom. It's not negative. It's not bearish. I can play markets long or short. So I don't need to be a bull or bear to sell a book or to sell a portfolio. I just don't believe it's sustainable. I'm not alone. I didn't think 5 years ago the Fed balance sheet would go past 6 or 7 trillion, and yet they did. And so I'm always amazed at how much they'll try and buy time with printed dollars. And now, of course, in the US, the Fed is trying to pivot. We can talk about that too. But at the end of the day, they've gotten so drunk, there is no solution. The hangover will be brutal. I believe in physics. I believe in, Einstein's eighth wonder of the world was interest rates. It's important. Interest rates matter. Debt matters. Physics matter. For every action, there's an equal and opposite reaction. And that goes to the Austrian School of Economics, like von Mises or Schumpeter. When you have this much debt, there's no way out of it without ruining the currency. And every bacchanalian debt party that creates huge market inflation and asset bubbles like this has an equal and opposite reaction. It will be the mother of recessions. It will be the mother of economic I think implosion, not the end of the world, not Armageddon, but it will be historical, because for most of my financial career, I've had nothing but tailwinds and nothing but central bank supported markets. And my generation in particular doesn't remember the 70s or inflation, or certainly the 30s. And so I think academically and personally, we're about to hit into an abysmal period. I think the signs are all around us. That's a long answer, Anthony, but I mean, there's a lot of problems. The main problem is a fantasy of printing money to solve a debt crisis, and the debt numbers are absolutely unsustainable. The debt levels today, the fantasy of modern monetary theory or central bank policies all around the world. And I think the counterparty risks in so many markets are three of the biggest risks that are undeniable, not to mention all the geopolitical risks happening at the same time.
Yeah, wow.
Yeah.
So it's great, crazy thing. So if we look back at sort of 2008, you mentioned that could be maybe not the beginning, but it's really where it amped up. And Ben Bernanke did multiple rounds of QE, and it's
Yeah.
funny, I think he was given the Nobel Prize for Economics this year, which is interesting. So do you think it was just that maybe the first one was important to get liquidity through the system, and it was just the fact that they kept almost go back into the jar and keep pushing it out, or do you think it shouldn't have
I think
occurred?
it was a critical moment in history and time, and this is where politics and finance overlap. Personally, it was an opportunity to be realistic and honest with the American people, with the American markets, with the American banks, which was contagion effect globally. But Bernanke is a politician. I think, by the way, his Nobel Prize should have been for fiction writing, not for economics, because it's absolutely anyone can be a hero for creating money out of thin air and calling that a solution, because it bribes and buys time. It buys office. Politicians in the White House, left, right, or center, don't want to admit to a recession. None of them do. Their main priority is reelection, and that's just been true almost without exception. No politician wants to face a financial crisis, and the easiest thing is to go to the bar and crank out the bar tab and print more money to avoid it. And central bankers are just politicians, and they're just wolf in sheep's clothing. They claim to be independent. They're more than they're linked at the hip with our financial and our political movements. So central bankers want to look good. Politicians want to be reelected. So the psychology of power and the corruption of politics in 2008, Bernanke and Geithner and Paulson got together, former bankers and politicos got together and effectively solved a crisis by creating money out of nowhere, which is inevitably addictive, inevitably inflationary. That was an opportunity to just admit that banks were over their skis in debt with subprime mortgages and toxic, asset-backed securities or mortgage-backed securities. That was a time to see guys like Jimmy Kane and Dick Fuld at Bear Stearns, Lehman Brothers, or frankly, even at Citi and Goldman. Some of these executives should have been called to task and punished, not rewarded. So you created a massive moral hazard. And we could have had what von Mises would call constructive destruction. Whether you're on a football team, a polo team, whether you're studying for the bar exam, or whether you're competing for entrance into grad school, you got to compete, and the strong survive and the weak get pushed aside. It's the same thing with companies. It's the same thing with banks. It's the same thing with governments. If you're in debt and you have bad debt, you have to punish the banks that levered that debt. You don't bail them out. You don't call them too big to fail and then save them and put that on the taxpayers' back. And that's effectively what happened in 2008, 2009. Again, Bernanke promised it would be a short-term solution, that there would be no consequences. Well, it ended up lasting for over a decade, and the consequences was it's completely neutered the inherent purchasing power of the currency, regardless of the dollar's relative strength. Its inherent strength is weakened. And again, that goes back to von Mises. All debt bubbles lead to a financial crisis, which leads to a currency crisis, which devalues the currency. And we're not going to be able to avoid that. So I think the opportunity in 2008 was to be austere rather than to be cowards and effectively, solve that problem. There are many who disagree that that was an essential measure. We needed liquidity. We had to save the markets. ATMs around the world would have been closed down. The financial system would have ended. I think all they did was postpone a much, much bigger problem, which we're heading into, which will be a reset. It's already been telegraphed by the IMF and most of the banks, and now there's a Fed coin. They're already paying the price for the sins of 2009 now. They just postponed it, and they bought us a huge market bubble, a huge wealth transfer, but they also bought us a cancerous amount of currency destruction, debt destruction. And, I think the decisions made in 2008 were historically poor, but they felt good at the time because everyone was terrified. They convinced us that the world was going to come to an end if a few banks failed, or frankly, if all the banks failed. They should have been restructured. They should not have been bailed out. That's my strong opinion, and I'm an alumni of those banks, and I'm an alumni of the hedge funds that brokered through those banks. But the leverage was unforgivable, and the behavior was openly clear at the time, not in retrospect, and it was just a ticking time bomb, and the counterparty risk was appalling. And so, no, I think it was a terrible decision made in 2008, and the crisis that's going to happen in the next year or two, it's already happening now, in my opinion, is the direct consequence of, frankly, the cowardice of the administrations in those days. Because again, everyone wanted to be reelected or look good or save their positions or quote unquote save the world. Again, for Bernanke to get a Nobel Prize for that, I think many of us on Wall Street are laughing about that. That seems like a very political propaganda prize, not a merited prize by any stretch of the imagination.
Yeah, I think from my perspective as well, I think it was 2018, 2019 when hedge funds were over levered and basically the Fed went in to save the repo market. That was really when you realized that they're here for that, and they're just trying to do whatever they can. But do you think there's a possibility that you meant they probably should have done austerity in 2008, they probably shouldn't have pumped money through the system? Is that still possible now, or is it too far gone?
Well, again, the more things change, the more they stay the same. If you start from a premise, and my premise is this, and if I'm wrong, I'm wrong, but my premise is politicians and central bankers are self-interested humans, and human nature and human weakness is almost more important than bond spreads and interest rates and inflation statistics and cap structure amounts and balance sheets, because human nature, in this case, they're not going to be able to avoid the problems. The problems are already here. The problems are already here right now. We are in a recession, despite the redefinition of a recession. In my opinion, an inverted yield curve and 2 back-to-back quarters of negative GDP is a recession, but central bankers can redefine recession. We have much higher inflation than is reported. So we have an inflation crisis. We have a recession crisis. We have market bubbles that are still massively overpriced by PE multiples. We have far, far lower to go in the equity markets. Bond markets are on a respirator since 2009. They've been artificially supported by quantitative easing. So literally anywhere you look, from Main Street inflation and market bubbles to overheated bond and stock markets to wealth inequality to a over-leveraged Fed whose balance sheet is hideous and it's in a corner, there is no way out of this. We're already in a problem. It hasn't fully affected us in the way, say, 1929 or Black Monday or some huge headline-making crisis, but you've got a wealth transfer, you've got a struggling Main Street, you've got an over-levered risk asset market that's headed for further pain, you've got a Fed in the corner, you've got an inflation-deflation debate, you've got people on the streets in Europe and in the US, but particularly in Europe, who can't afford energy bills. You've got political policy that's a nightmare. And every central banker I've ever studied or known of, other than maybe maybe Bill Martin, maybe Paul Volcker, most of them are cowards. So they'll never take responsibility. Bernanke, Yellen, Powell, they'll never take responsibility. They'll never admit anything's wrong. They'll never get a recession right. They never called a recession. They're the track record is 0 and 10. So they'll always come up with excuses when the math is bad, the words get different. So they'll misrepresent inflation, they'll misreport and misdefine a recession. We're already in all of those things, but it's only going to get much, much worse, in my opinion, based on simple laws of mean reversion, overinflated multiples in the equity markets, a bond market that's unsustainable unless they print more money to keep yields down and keep interest rates down. And Powell's policy right now of trying to fight inflation with rising rates looks good on paper, makes him feel like Paul Volcker, but for a number of reasons that won't work. And again, that is not gloom and doom, it's math and history. And so I think we're already in a lot of pain. I think there's much more pain to come. We're not going to muddle through it this time. There's already too many people that are going to be facing layoffs, that are facing inflation. That's an invisible tax anyway for many people in the middle class. The middle class in America has all but disappeared. I spent a lot of time in Europe. The middle class that I see in Germany and France are struggling. They're struggling, and they're angry, and they've lost faith in their politics. They've lost faith in their currencies, their central banks. For the wealthy clients that I have, they can protect themselves, but for the uninformed middle class, and God knows they've got other things to worry about. They're living check to check. They don't have time to worry or think about central bank policies or interest rate swaps or repo markets. It's like me trying to learn dentistry. It's not that easy, but I think they know there's something wrong and they don't trust it. But what is happening right now, Anthony, in my opinion, is all the consequences of years of living beyond our means and monetizing our debt with mouse click money. We're blaming that. When I say we, the policymakers are universally blaming this on the COVID crisis. You know, the IMF to Citibank to the White House is blaming this on the COVID crisis, or they're going to blame it now on the Putin inflation or the war in Ukraine. Again, regardless of what you think of that war, it was convenient excuse for inflation, which was already here pre-war. And COVID, the bond markets and the equity markets were heading for a massive crash prior to COVID. And COVID, in my opinion, March of 2020, when the markets were down 36, 40%, they would have gone down 80% if the Fed had not printed trillions of dollars in a matter of months. So again, that's a recovery, but that's like, again, it's fake. It's like I joke, it's like being a best-selling author. You write a book, your rich uncle buys every book. So technically, you're a best-selling author. No one's buying your book. No one likes it, but you've sold 1 million copies because in some garage somewhere, your uncle wrote a check and bought all the books. We've bought a record-breaking market, but it's benefited no one other than a minority of the population, the top 10%. And so it's a fake bestseller. It's a fake market record. It's a fake market bubble. Again, that's just math. That's not even cynicism. That's not even my opinion. Everyone knows it, but no one really cares when you're making money. You don't really care. And now that markets are gyrating and everyone's worried about what the Fed does, you know, the Fed is the market. The central banks are the market. What they do decides the market direction. Natural supply and demand, all the principles of basic, good, honest capitalism disappeared way before COVID. They disappeared in 2008, but I'd say they disappeared long before then as well. But so I think we're already in painful times, and they're only going to get worse.
Yeah, it's shocking to think. So, you know, obviously you agree that we're probably going to see a recession. There's
I think we're already in one.
we already are in one, and you know, lots of
Yeah.
people predicting, you know, especially early next year in the US specifically, could get even worse. You don't buy, because there's lots of people saying, oh, you know, 2008, other recessions, we've then gone from inflation to quite large deflation. So you don't think that's going to be the case this time?
Well, look, we have, you know, let's look at the U.S. inflation, which is kind of a benchmark for the world. The U.S. inflation right now is around 8%. You know, the scale used to use inflation, to measure inflation, the CPI scale, was created by the Bureau of Labor Statistics in Washington, D.C. That's an open fiction. Everyone knows that in Wall Street. It's a joke, but it's, you know, the Fed's never wrong, but they're always right, right? They're never right, but they're always wrong. So let's just say we have inflation of 8%, but the real inflation is really using the same scale that Volcker era used in 1980. And this is, you know, shadow stats, but it's the truth. If you use the measure of the scale for measuring inflation that we used during the Volcker era, we actually have about 16% inflation right now. But let's just say it's 8% let's pretend for a second that the Bureau of Labor Statistics and the CPI scale is honest, which again, it isn't. But even if it is, at 8% inflation, that's painful for most Americans. That's crippling for the middle class and the lower middle class. But yes, if you have a central banker like Powell who says he wants to fight inflation, first of all, I'll argue that he doesn't. He needs inflation, but he'll just misreport it, which is like having your cake and eat it too. But Powell wants to be Volcker and say, I'm going to do what Volcker did. I'm going to fight inflation by raising rates, and I'm going to fight inflation. Well, again, when Volcker was the Fed chair, debt in the U.S. was about 800 billion. Today, it's 31 trillion. So if the Fed under Powell wants to be Volcker to fight inflation with 31 trillion in government debt, if he raises it to 8, 10, 12, 15% to fight inflation, or raises it to 9% to fight inflation, it makes the government incapable of paying interest on its own debt. So he can't be Paul Volcker, even if he wants to be. But again, so I think what Volcker is doing is being a politician, saying one thing and meaning another. He really wants inflation rates to be higher than interest rates because that's called negative real rates, and that's how every debt-soaked country throughout history gets out of debt. You deflate the currency, you debase the currency. I mean, this goes back to the Ming Dynasty, ancient Rome, 18th century France, Weimar Germany. Today it's a scam, and so they'll misreport inflation, but even if you go with the reported inflation of 8%, he can't raise rates high enough to fight inflation. So he's not going to fight inflation with interest rates. What he's doing is he's raising rates right now to take away the punch bowl a little bit from the markets, to create what he thinks he can contain market euphoria, because like William Martin, he doesn't want the markets to get away with murder anymore. He's trying to actually maybe do something good in that regard, take away the punch bowl of easy money. But what Volcker is really doing, he thinks he can contain a recession, like he can contain inflation, like it's a thermostat in someone's house. And so by raising the rates, he won't fight inflation through interest rate policy. He'll fight inflation by creating a recession. Literally, the Fed gave us the biggest bubble in history. It's going to give us the biggest recession in history. But Powell amazingly has the arrogance to think it's going to be a softish landing, that he can make this a semi-painless recession, or not as bad as you'd think. Well, again, I would argue with debt levels at historical record level rates, debt at record levels today, you can't have a softish landing with interest rate policies. If we have a recession at these debt levels, again, this is physics, equal and opposite action for reaction. With debt at record levels, currency is going to be debased at record levels. The recession is going to be at record levels. So I think the recession that we're already in, that we're limping into, is only going to get worse, because as interest rates go up, everything collapses. Everything in the U.S. and Western economy is driven by debt, and the cost of debt is interest rates. If those rates are too expensive, the debt becomes tighter and tighter. And if debt is the wind beneath our wings and debt is unaffordable, then our wings are clipped, and our markets and our economies and our businesses fail. And to think that we can do that softly or contain that in a measured way is arrogant, and it ignores history, ignores math. So we'll see much more pain, a much harder landing, which will be blamed at the time on COVID or Putin or something else, or global warming. It will not be blamed on the absolute mismanagement of our central bank policy since '08 and before. And at that time, Bernanke won't be signing book covers for his Nobel Prize. But again, they'll never take responsibility. So there are plenty of people in the markets who can play this volatility, make a lot of money on the down or the upside. But I think for the average citizen, they're being duped upside down and backwards. And as a former hedge fund guy, I see it. I see how rigged the game is. I see how unregulated the game is. FTX is a recent metaphor of what's wrong in all these centralized, unregulated markets, from the COMEX to the over-the-counter markets and the bond market game. There's so much unregulated crime, really, counterparty risk crime going on. It's just the regulators just don't follow. And so a lot of people still make money. The filthy rich will lose some money, but the middle class will get clipped, as always, every time.
Which is shocking to think. So I guess a lot of economists will say, oh, Japan, they've been able to get away with basically continuing to increase their debt through, as you said, they're monetizing debt. But I guess the challenge is, if there's inflation, that's not possible.
Well, look, Japan's, the yen has lost 50% this year, more than 50% this year. So yes, they can monetize their debt. Every time they have a JGB comes out that no one can buy, the Japanese citizens buy a lot of their own bonds. That's great. But when there's not enough buyers for their bonds, not enough support for their bonds to keep interest rates from spiking and destroying the economy, the Central Bank of Japan, the Bank of Japan, has to print yen to buy its own bonds. It buys its own stocks too. I mean, it's a completely centralized market now. It's almost a Soviet market when you think about it. It's completely centralized. And yet, so they have to print so much artificial fake money to support their bond market that, yes, they're still alive, so to speak. Their nose is just above water, but their currency is completely kneecapped. It's lost all its purchasing power. Well, people say, yeah, but that's just the yen. The dollar is the world reserve currency. It won't happen to the dollar. But again, I think the Japan example, which by the way, Bernanke went to Japan in the 80s after the Nikkei crashed and gave them the playbook for quantitative easing. The Japanese started quantitative easing before we did in 2008. That was Bernanke's playbook. Again, it's unfathomable to me that he got the Nobel Prize. I mean, honestly, it's unfathomable. But nevertheless, so Japan isn't a good example because its currency's been neutered, and And if you've been to Tokyo, it hasn't really changed since 1989 when the Nikkei crashed. That economy, that country it's kind of in a time warp. I'm not, of course, it's not a ghost town, but it's like a time slip because the country has never required, the Nikkei has never required its former highs, and that was 30 years ago. So, Japan was, I remember in the 80s, the sun never set on it was the rising sun. I mean, in the U.S., New York, the Rockefeller Center, everything, all the real estate was being bought by the Japanese. It was Hollywood movies were made with Japanese characters. That was the new thing, and it was over overnight. Boom, done. And then for years, the euro was the new dollar and the new currency on the movies and all the Hollywood things. Everyone wanted to be paid in euros, not dollars. That's done. And now it's the dollar. And eventually, again, central bank digital currencies already being telegraphed by the IMF for the last 2 years. Fed coin is already coming out. That's just another lie masquerading as a solution. It's just another fiat nonsense that they're going to blame again on extraneous circumstances beyond their control, like COVID crisis with a death rate of less than 1%, or a war in the Ukraine, which could have been avoided with decent statesmen. They'll blame all this, as they always do, on everything but themselves, sadly. But no, I think Japan is a terrible example in a sense because they've never really recovered and their currency's been destroyed. And we're seeing that same currency weakness. The euro's down, to parity basically with the dollar after 20 years. The British pound sterling, as you know, in the UK, I mean, I've never seen it so cheap. It's unbelievable. So, the Bank of England, the European Central Bank, the Bank of Japan, they all are doing the same thing, but they're not the world reserve currency, so they can't afford to raise rates. All they can do is debase their currency more. And it's brutal. And the U.S., as it raises rates, all these other countries, including Japan, England, and the European Union, has dollar-denominated debt it has to pay back, and that money is now more expensive because the dollar is stronger, forces all these central banks in Europe and in emerging markets to devalue their currencies even more to pay this dollar-denominated debt. So it's a gift that never stops giving. The U.S., whether it's foreign policy or monetary policy, we keep the world on its knees 24/7.
Do you think that's a catalyst then that there'll just be sort of, I guess, internationally there'll be all these collapses? You could say zombie companies as well that have been relying on low interest rates. Now they have to finance their debt. Variable rates and mortgages as well in many countries. Do you see these as sort of the weak points in the system?
Yeah, this was something I wrote about a couple of years ago. The European banks were basically guaranteeing European governments were guaranteeing the loans of commercial banks, and that hardly made the headlines. I talked with I talked to a bunch of economists in the UK and in Europe about this at the time, and it kind of went off. It wasn't even really making the Economist or the Financial Times. It wasn't making the Wall Street Journal, but that was, in a sense, that's nationalizing the banks. Right? I mean, in a sense, what was the 2008 bailout? We didn't nationalize the banks by putting bureaucrats in the C-suites, but we effectively bailed out the banks, and now we're guaranteeing their loans. We're centralizing the banking system, and we're still overpaying the executives, but it's a form of nationalization. And yeah, banks in some sense are too big to fail. They're the liquidity sources of the system. You need money to flow through banks. I don't think the banking system will fail. The banking system will be fractured, and then there'll be a massive reset and restructuring and a guaranteeing of the banking system by governments. That's what I see happening. What you saw with FTX, which is just a small canary in the coal mine, but it's a metaphor for so much things, counterparty risk. I was talking to an Australian actually who lost millions over the weekend. He lost millions with FTX, and we've been arguing for years. I told him not to be on that exchange, not because I was a psychic, but anyway, I'm a gold guy. He's a crypto guy. But he lost millions. He was telling me, Matt, I was sitting there on that screen. I could not withdraw. I could see all my money. All the digits were there, but there was a nice little message saying not accepting withdrawals or deposits. Okay. And for days, it was just a little wheel turning, and now the money's gone. Now that's one absurd example of an absurd executive and an absurd exchange that's now getting some headline attention. but it's effectively counterparty risk for over leverage and misuse of client funds. Well, commercial banks are over levered, and with fractional reserve banking, they're misusing client funds. You could go to Wells Fargo or Citibank one day and not get your withdrawals. Again, I'm not saying that everyone who has money in a commercial bank is not going to be able to get it. It won't be like FTX, but we've definitely seen depositor freezes. I think banks are going to have liquidity moments. We're going to see more and more crises like this, not the end of the banking system, but more and more liquidity squeezes and more headlines and more distrust of digital money, whether it's at Citibank or Goldman Sachs or whether it's at FTX. There's going to be less and less faith in the liquidity of your digital money because fiat money at Citibank or at FTX is digital money. I think people are starting to scratch their heads and wonder, is their money safe? And of course, these banks won't fail like FTX. The governments will bail them out, but to bail them out, they're going to have to print money to keep them alive. And if they print money to keep them alive, that's like adding water to a glass of red wine. It dilutes the flavor, it dilutes the currency. And that's the biggest risk to me is there's nothing a money printer can't fix. You can solve anything with a money printer, but you will destroy the money you're printing. And that's the twist. And central banks now have a choice, and Powell has a choice. And the main choice is, do I let the markets die, or do I print a lot of money to save them and let inflation rip? And right now, he wants to let markets suffer. When something really breaks, he'll start printing again. He'll have no choice. As a politician, he'll have no choice. And when he starts printing again, currencies are going to lose even more power. And that's when gold, I think, will do even better. So they're in a corner they put themselves in, and they're in a rock and a hard place, and they have to pick their poison. There is no good solutions left. On that, I've been arguing for the last year. There are no good solutions left. We joke here in Europe, it's like being in Poland in 1939, just before the Germans invade. People are still outside. It's September. You're having your coffee. The sun is out. Weather looks good. But something seismic's about to change everything. And no one knows exactly when that army comes across the border or when this system starts to collapse. It's already collapsing in many ways. But the good thing is for politicians, they've got somebody else to blame themselves. And that's a virus that really wasn't a pandemic. And it's a war that could have been avoided in the Ukraine. So they've got it all figured out, so to speak. And they'll have something to blame because they'll never take responsibility. I can't even remember the last time I saw a politician, other than Kennedy after the Bay of Pigs, actually admit that they were wrong. They just don't do it. They don't know how. It's pathological.
Definitely. So, and yeah, you mentioned some banks there that are having issues. You could say, Credit Suisse and even Deutsche, and yeah, they seem like they're sort of at that stage potentially similar to FTX, where client withdrawals potentially could get to the point where it's a liquidity crisis.
Well, absolutely. There's a run on the bank already at Credit Suisse because what was Credit Suisse? It was over-levered bank. What was FTX? An over-levered exchange, unregulated, centralized. They were making their own markets. Sang Bankman-Fried was a prop desk. He was making his own market for cryptos. That's what prop desks used to do at the big banks. And what else was he doing? He was using leverage. That's what every bank, it's that addiction. They can't stop themselves. They turn the leverage on. And he was also misusing client money. That's what banks do every day. They leverage client money, and they're, at least commercial banks are more regulated than the FTX. But look at the sins of Deutsche Bank or Credit Suisse or the derivatives market, or look at their notional value of their derivatives exposure. It's unfathomable. It's unfathomable. And the notion is that, if we're all crossing the street at the same time, we can't get hurt. That was the big illusion. But there's counterparty risk and all these things. And again, not gloom and doom. It's not the end of the world. It's not the end of every bank. It doesn't mean you're never going to go to an ATM and get your money. But I tell you, it's the end of paper money with any real value. It's the end of the inherent purchasing power of your currency. And as the IMF has already telegraphed, there's going to be a central bank digital currency that won't be orderly. But what that will be, and this is the most disconcerting, what it will be is very monitoring and centralizing of your life, of your personal and private life. And this is the theme, I think, that doesn't get talked about enough, because market guys like me who worked in hedge funds or banks, the ones that were always most interesting to me were the guys who didn't study finance in college or grad school or just economics. They studied history or philosophy or literature, because if you study history and philosophy at the same time that you study markets, you realize the patterns are so easy to see. And throughout history, without exception, when you have a debt crisis of this level, it always leads to a financial crisis, which leads to a political crisis, which leads to a currency crisis. And then that leads to social unrest. And then social unrest leads to extreme centralized control from either the extreme left, or the extreme right. And that's what we're seeing all over the world right now, from China to DC. whether it's the extreme left or the extreme right, you're seeing a desire to have more and more control over the citizens because governments are afraid of pitchforks. And so because they're afraid of pitchforks, they'll come up with lies, blame it on COVID or blame it on a bad guy out east, but don't blame it on us. We're here to help you as we've just taken all this money and given it to the top 10%. And I think what they're trying to do now is control the narrative and control the people. And a centralized digital currency means every dollar you spend could be turned on or off like a lamp if they don't like what you're writing or what you're interviewing or what you're saying or where you're going or what you're doing. That's just another form of control masquerading as support or as a solution. The idea, every solution that comes out of a central bank, as Thomas Jefferson, Andrew Jackson, and many others have warned, is never a solution. It's a poison. It kills the system from within. And so this newest solution, a central bank digital currency, is just what? It's just another lie. It's just another fiat currency now with blockchain technology as opposed to printed out. But it's going to have some basis in gold, some partial coverage in gold to have any credibility. So I think more and more citizens of the world are catching on that printing money, whether it's printed on a mouse click at a central bank or on a digital currency at the IMF or elsewhere, isn't real money. And I think it'll be very disorderly. I think we're heading into, we've already entered since 2020, since the massive Fed unlimited QE, since 2020, since the COVID policy, the COVID reaction, the COVID narrative. And now what we're heading into is a seismic shift in our personal freedoms, in our personal lives, and our financial lives, but also in the markets. We're heading into some real recessionary pain in the 23. I think by 24, we'll see central bank digital currencies, I think within 2 years. Things are happening so fast right now, so fast. And again, sounds very dramatic, but most of us are talking about this off the scene, so to speak. Guys I know who run lots of money for hedge funds, they're more cynical than I am, but they know how to trade, they know how to arbitrage, they know how to reverse lever. So they can make money in this volatility if they're good. Most of them are just levered and not that good, but they all have the same cynicism about the macro view and about the central banks. We are in a situation here that doesn't have an easy solution. Again, Anthony, you can always save any market. You can always print money to save the market, but you will always risk the currency by doing so. So there you have it. You either have a dead currency or a dead market. You can't have one of the, you can't save them both. And to me, they're going to choose to kill the currency, blame it on COVID and Putin, and start over.
Yeah, we've already seen, I think Bank of Japan mentioned starting next year, they're looking to roll out parts of their central bank currency, which would be really interesting. So you see sort of like a central bank digital currency / Bretton Wood 2.0. Is that sort of where you see it going?
Yeah, I mean, again, the IMF came out with this during the convenient crisis that was COVID, which, by the way, was the biggest bailout. It was a bigger bailout than 2008 in the repo markets and the bond markets, despite the PPL loans and the saving Main Street economy, which barely got a sliver of that money. Most of that money went back into the bond markets. So again, COVID was a great bailout, but in 2020, the IMF had the audacity to come out with this beautiful white paper and little video with nice music in the background saying, COVID, just like 1944, debts hit all-time highs. We have to come together as a world and think about a new Bretton Woods. They called it a new Bretton Woods. And again, I'm an American with a European background, lived most of my life between both countries, educated in Germany and the US. And I live in France and work in Switzerland. So I have a perspective that may be a bias. And where I live in this little village in the south of France, there's still people who talk about the Second World War, and there are still monuments to the First World War. But for the IMF to compare COVID to World War II, where I look out my window, I can see the cemeteries in the distance. They're filled with kids, 17, 18-year-old kids from the Second World War and the First World War. 85 million people died in Europe. Cities like Rotterdam, Dresden were destroyed. Cities like Paris were occupied. London, the Blitz. You cannot compare COVID to World War II. It's an insult to history. It's certainly an insult to any of us who have family members who remember that war. It's an insult to this continent. It's like calling Gallipoli a beach party. You're an Australian. Gallipoli wasn't a beach party. And COVID was not grounds for a Bretton Woods 2.0. So they did say, though, because of COVID, we have to have another Bretton Woods 2.0, which means a new currency system. But the problem with our debt levels and the problem with our currencies was there long before COVID. I wrote a book called Rigged to Fail. It came out in 2020, just before COVID. And I already said something's going to give, something's going to break. It was the bond market was stretched too thin. The bond market needed liquidity, but they couldn't just bail out the bond market like they did in 2008. Again, that no one would accept another bailout. And then suddenly COVID came 3 months later, and now they've got the biggest bailout in history. It was a bigger bailout than 2008. The banks got liquidity. The central banks flooded the banks with liquidity. So that was a backdoor bailout again in 2020. So, I think the central banks have already, in the Bank of International Settlements, the IMF, have already telegraphed using COVID as the pretext that because of all these seismic changes, we're going to have to, at some point, have a central bank digital currency with blockchain technology. It won't be Bitcoin. It's not going to be Bitcoin. It'll be the same type of technology or ledgers, but they're just going to digitalize this. And so that will not be orderly, in my opinion. I can't begin to try and explain how that will roll out. It certainly won't get the cooperation of the BRICS or Russia and China. So it'll be a very multipolar seismic shift. It won't be as orderly as 1944 Bretton Woods, when America really had the monetary and authoritarian and even immoral position to do this. It'll be much more chaotic this time. But I think they've already telegraphed this 2 years ago, and that's how they do it. It's like a psyop. You kind of plant the seeds, and then it comes a few years later. And so it's already, I think, inevitable. And the Fed coin is out. The Bank of Japan's talking about it. It'll be very interesting to see how that plays out, but that will be messy and painful for a lot of our financial systems. Again, sounds very dramatic. You can't make this stuff up, though. It's so crazy, and it just, all our heads are in the sand, even my own. I don't want to think about it. I don't even want to be right. Egon and I talk about this all the time. I don't even want to be right about this anymore. It's hard to imagine, but it's already what we just went through during the COVID lockdowns and the insult to human liberties and civil liberties and individual choices and freedom of movement and freedom of press. What we've already been through is scary enough. And that's just chapter 2 and 3 of a much larger book. So, you know, financially, I don't see how this is going to be pretty. Hopefully, human nature and politics gets better, but that's naive, I think. But financially, there's no way out of this. Even a reset, they're going to have to. They're going to have to see a lot of pain and austerity through that reset. And the key thing for politicians now is to find someone to blame. You know, that's their main problem. I don't think they're going to save us from a recession by rising rates. That's going to create a recession. It might fight inflation. A recession is deflationary, it's disinflationary. So of course that can, that, that's like a cure that's worse than a disease. But yeah, you can beat inflation with a global recession. Great. But I think the real way to beat inflation throughout history is to debase your currency and have negative real rates. And that's what Powell's going for. Let's think about it. If you've got inflation that's really closer to 16% and you've got a yield on the 10-year of 4%, that's negative 12% interest. That's a great way to backdoor your way out of debt without the world having to notice it. But who suffers? It's the Main Street, it's the middle class who suffers, because that invisible tax of inflation right now is crushing them. So I think it's really sad, but sadly nothing new.
Yeah. So, in your perspective, how are you looking to protect your wealth during this period? I know you meant to talk a lot about gold. Is there anything else that you're sort of looking at?
This is what I was telling my Australian friend who just got, kneecapped by the FTX, and a lot of my friends are in cryptos. Some have done really well, but, I'm the boring guy, the less sexy asset, the tangible asset. I believe in tangible assets. It doesn't mean that every crypto owner is going to get fleeced. It doesn't mean I'm making fun of crypto people. I understand the philosophical argument behind Bitcoin and others. I have a lot of respect for that, but I think digital assets are like fiat currencies. They're only worth the value of the paper or the code that's behind them. But I could be wrong on Bitcoin and others, but I'm old school. I'm not looking to get rich quick on Bitcoin or crypto market. I wish I had bought crypto. I wish I had bought Bitcoin at $10. I mean, of course, I would have taken that lottery ticket any day, but I never considered that a store of value or alternative currency or way of wealth preservation. So when you've made a little money, my goal is to preserve what I have, and I want tangible assets. For younger people, I understand the temptation to try and get it. I got lucky in the dot-com bubble. I didn't deserve that either. So I'm not saying that like I'm some wise sage. I totally won a lottery during the IPO craze of the dot-com bubble. But when you reach a certain age, you have to preserve wealth. It's not about getting rich quick. It's about keeping the purchasing power of your wealth. And to me, that's tangible assets. And gold, I know you can't take it to Target or Walmart and buy groceries with gold, but gold you can convert to currencies at the flow price. And gold is a real tangible asset that if you store it properly, can't be. I'll never have to think like my friend over the weekend where that wheel's just spinning and I can't withdraw my money. I can't even imagine the frustration of seven figure income that you can't access and is disappearing in front of you. I know that sounds like an extreme example. That literally happened to him. And so for me, a gold bar and a hole in the ground somewhere that stares at you, still as unsexy as it is more loyal. And that may be archaic thinking, but gold's been here for 5,000 years. Crypto's been here for about 13 years. I know crypto's the new generational thing, but I mean, it sounds crazy, but it's God's money in a sense. I'm not saying that as in a kind of religious way, but it's simply natural wealth. It's always been here. It always will. It always gets the last laugh. It doesn't have the standard deviation of crypto. It can't make you rich overnight, but it can't make you poor overnight. But physical gold just makes me feel safe. Other tangible assets are just certain commodities in general, and certain real estate, of course, is not real estate like home flipping, but I'm just saying land, agricultural land. They're assets that to me will stand the test of time. If you're looking to get rich quick, you can speculate, but I tell my kids, and my daughter's at Goldman, she's got I tell her, just wait till there's blood in the streets, the Rothschild analogy. Wait until markets are well below their mean levels, and then start investing. Right now, no matter at these multiples, you're paying too much, even for discounted dips. Somewhere I read the other day, I don't buy dips, I buy catastrophes, but that's true. And the only good news for the younger generation, I've said this 2 years ago, I'll say it until it happens. When these markets totally die, uh, like the bond markets did in the early 80s, or the stock markets did, when you've lost all faith in the world and the markets, and they're priced at almost nothing and multiples are below 8, that's when you can buy. And that's where you make your generational wealth. The rest, and to try and short a market down is also dangerous. You get called out. If you're not good at that, that can be really dangerous too, because there's a lot of short squeezes in a dying market. So I just keep it simple, stupid. Wait for a mean reversion. Um, Although you could argue that, well, the Fed will just print more money, the markets will never die, they'll just dilute the money. Well, then you really should buy, in my opinion, physical gold and silver. Your generation, others may want to go with the Bitcoin, but the way Bitcoin behaves to me is like a tech stock or a growth stock, not an alternative currency, not a store of value. It just trades at a higher multiple than the tech sector. But if you look at its behavior, it moves where the tech markets move. It just moves faster in both directions. And it's the biggest wealth generator I've ever seen. I wish I'd bought it. Don't get me wrong. But in terms of where we are now, I actually think Bitcoin's going to go higher after this FTX scandal. I think actually the FTX scandal could be a good narrative for Bitcoin, because it proves the need for more regulation and weed out exchanges like Sam Bankman-Fried. But in the long run, I think this new central bank digital currency, I think Bitcoin's a bigger threat to them than even gold is to the central banks.
Yeah, I think if you look at sort of Turkey today, I'm not sure if you've seen the charts saying in comparison to the US, I think the stock market's gone up like 60 or 70% to the US
Yeah,
dollar.
I
And it
know.
just goes to show like how important valuations are, because I think the PE ratio for the whole of the Turkish market was like 3 on average. So, crazy to think. But if you think about that, it's a lot of times, as you said, it's waiting for that opportunity, and there could
Yeah.
be disaster all around, but there are those opportunities available.
Yeah, well, it's what was it? The Oracle. Buffett said the one thing we learn from history is nobody learns from history, right? And I think with us, with Egon, every week we have to come up with an article, a new thing to say. There's always something we have to write for Zero Hedge or for King World, or this, keep current. But the truth is, there's always something to write about because the markets are moving so quickly. But the movements of history and markets and gold and commodities are pretty simple. And the movement of politics is pretty simple to watch. It's like combat. You can spend months being bored and then 15 seconds of intensity, and it's like that's what markets are. And so in a lot of ways you have to be patient. You have to be patient for people say buy low and sell high. Almost no one does it. They all buy high and they sell low. They all move in herds and packs. And contrarian investors, not contrarian just to be cool, but contrarian because they see the movements and they have cash available when there's a time to buy at a bottom or to buy an unloved asset class that has potential. I mean, even if you didn't track oil at all, when oil got to those record lows years ago, you didn't have to have a theory on oil or OPEC or RAN or public policy or geopolitics. You just know at some point in the next 5 or 10 years, oil's going to go up. So why not buy it at an all-time low? And for those who did, including myself, it was the best trade I made since the dot-com bubble. It was just common sense. Wait until something is so underpriced. And right now, everything's still overpriced. And so you're speculating, you're picking up dimes in front of a train. But if you're good at that and you can leverage those dimes, some people can make money. I think just be patient. My daughter's 27. She's doing well at Goldman. I said, just save your money and wait for that market to really, really tank and go all in. And wait, you'll get that moment. And that's cruel, but in the meantime, I tell people that are older investors to get out of the markets, because your pension funds aren't going to save you. Your 401k isn't going to save you. And the only way to keep that 401k where it is today 10 years from now is to monetize the market with money that has no value. So, what good is $100 bill if it only buys you a candy bar, right? So $100 portfolio that only buys you a candy bar may look the same as it did 10 years ago, but it won't get you anywhere. So we're going to have some disorder in the next 3 years. We're having disorder right now. We've had disorder since 2020. Frankly, we've had disorder since 2008. We just had a really nice market bubble in the meantime. But I think take a look at history, look for the dips, look for crises, not just dips. Buy the catastrophes, not the dips, and you're going to see a mean reversion. Just look at the mean reversion. I think you can get the S&P at really low discounts in the next couple of years. Otherwise, the only alternative would be is if the Fed monetizes the market with mouse click money, in which case you damn well better have some precious metals. I have to say it, because that will be, it's not necessarily a hedge against inflation, it's a hedge against the death of inherent purchasing power of paper currencies or digital currencies. The inherent purchasing power of mass produced mouse click money is getting weaker, and gold can always be insurance against that burning currency. For sure. And that's, in a sense, I'm just an insurance salesman, and I don't look at gold as a get rich quick scheme. It's wealth preservation. It's kind of boring, but you'd be amazed how many very wealthy clients buy a lot of gold, physical gold, because they know that. And I think the non-wealthy clients, or the real people like my parents or the rest of the world, you can still buy gold. You can still do it. Physical gold, not ETF gold, not gold at Goldman Sachs or Morgan Stanley held in a non-segregated, unallocated account. If you can buy physical coins here and there, even though you're going to pay premiums, that's good insurance. Just like you have insurance for your house or your car or your health or your body, you got to have insurance for your currency. And regardless of whether you're gold bull or bear, it's hard not to know that that's true. And gold has been much more anti-fragile even this year than other asset classes. And gold can go much higher and much lower, but I know that the paper price of the euro, the yuan, the kroner, the yen, the dollar, Canadian, Australian, they're just getting weaker every day. They just are. Even the US dollar is strong in the DXY only because the euro and the yen are just getting crushed. So it's like being the sickest patient in the ICU. It's nothing to brag about, you know.
Matthew, thank you so much. I really appreciate your time. So I guess my
Yeah.
last, is that the message you want to leave people with, or is there another message you'd like people to take away?
I mean, again, it's, I think when you don't work for a bank or a hedge fund and you work for yourself, like me, I can tell you my honest opinion. It doesn't mean I'm telling you the truth. That's an arrogant statement. This is the truth. Matt, Egon, Druckenmuller, anyone, Musk, anyone. This is the truth. I'm not telling you what I think is the absolute truth. I'm telling you what absolutely is my true opinion. My advice to everyone is to get more and more informed. You can argue with me. I love a good argument, a good debate. Everything I've said is what I believe. That's the honest truth. It's not the objective truth. It's just what I believe is the honest truth. But my advice to younger investors, older investors, new investors, seasoned investors is challenge your assumptions. If you're pro gold, look at Bitcoin. If you're Bitcoin, look at gold. If you're pro bond, look at the risks in the bond market. If you think your risk parity portfolio is safe because someone at Goldman Sachs told you so, question them. Question yourself. Engage in these debates. Even question your politics, because there is no absolute right. But I think there is a lot that needs to be re-examined, and I would really invite people to challenge themselves. Markets can be interesting because they're tied to history and human nature, and but I think we have a lot to be concerned about. And I would ask people to take all of my opinions and not agree with a single one of them, but challenge yourself with them, and vice versa. We do it all the time. I'm always looking for someone with different views who can teach me something, and just stay curious. But I think stay very cautious, because the ice is cracking already. It's cracking already. And I think maybe we talk in a year or two, and I think by next year, it's going to be much, much worse than this year. And it was already a tough year.
Yes, here I think so. Matthew, thanks again. If
Yeah.
anyone wanted to find out more about your work and what you do, or anything else released, where the best places to?
For gold, it's goldswitzerland.com. It's our URL. It's real easy. We're called Matterhorn Asset Management. I wrote a book called Gold Matters, which talks about the history of gold, for thousands of years, and why it matters in 2022 and 2023. And then I wrote a book a couple years ago called Rig to Fail, which goes into more detail about the kind of things that are pre-FTX that were happening all the time. There's so much that's wrong with capitalism, and I'm a big capitalist, but I haven't seen it in a while. There's a lot of things wrong with modern capitalism right now. So, yeah, those are the books. But our website is Gold Switzerland. We have a lot of articles there, and encourage people to come look at them in English, German, and French. So there they are, based out of Switzerland.
Yeah, awesome. Put that in the description below. So, Matthew, thanks.
Okay, thanks, Anthony.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.